If you had £50,000 to invest today, would you put it in stocks or property? It's a question our team are asked daily, and we spend every day helping investors from the UK, Dubai, and beyond make this exact decision. We see the real numbers, talk to real investors, and the gap between stocks and property is bigger than most people actually realise. So in this video, I'll show you a clear comparison of what each option really delivers over the next few years, the factors that completely change when one comes out ahead, and how to decide which makes sense for your money and your personal goals. Before we dive into comparing stocks and property, we need to clarify something most investors overlook. Most people jump straight into which has the highest return without ever defining what becoming richer actually looks like for them. They chase percentages they've seen on YouTube or heard from someone at work, completely ignoring cash flow, volatility, and tax. They think richer is just a bigger number on a screen. Just last month, I sat down with an investor who told me I want the highest return possible. Fair enough, most investors do. But when I asked him what his specific goals were, everything changed. He was looking to replace his regular income to cut back his work hours. He wanted a no-stress investment solution without having to be worried about major losses or market crashes. The conversation soon changed from talking about chasing returns to designing an outcome that suited his real goals. Richer means different things to different people, and stocks and property deliver wealth in completely different ways. For most serious investors, being richer means three things: higher net worth, stronger, predictable income, and a risk profile you can actually live with. Stocks can be brilliant for long-term growth and can offer some truly incredible returns, but short-term volatility can be destructive. Property tends to move slower and steadier, with leverage and rental income doing the heavy lifting. Without defining which combination you actually want, any comparison becomes meaningless. Here's my advice to investors. Identify in one clear sentence what richer means for you personally. For example, I want my £50,000 to generate £500 a month in income. Once you have that clarity, you can honestly evaluate whether stocks or property are more likely to deliver that specific outcome, rather than just gambling on whatever sounds good. Now, a major mistake we see is investors guessing their returns. That's how they end up genuinely disappointed in 2 or 3 years and pushes them to make rash investment decisions with their other capital. To help you avoid that, we've created a free investor toolkit that includes a straightforward ROI calculator. You can enter in your own numbers for UK property and actually stress test what your money could realistically do for you. Use the link in the description to access it. Now that you're clear on what richer actually means for you, let's compare stocks and property across the areas that matter most and see where each one really wins. Firstly, let's look at leverage. Most people compare a 10% stock market return to a 5% net return on a rental property and may presume that stocks is the superior option. Let's take a deeper look though. Let's say you have £50,000 to invest. Put that into a stock index at 7% a year for 2 years, and by 2027, you've got around £57,000 to £58,000 before tax. Not bad. But use that same £50,000 as a 20% deposit on a £240,000 UK apartment, and if that property grows by just 4% in a year, the capital growth is on the full £240,000 asset, not just your £50,000. That's nearly £20,000 in growth, and we haven't even talked about rental income or mortgage payments yet. The one thing to consider with property investment is stamp duty. This is an additional cost when purchasing property, but this will wash away over time as a cost with a long-term investment, which is why investors use leverage. And when I refer to leverage, I mean using the bank's money to mortgage and finance a much higher value asset. In property, sensible leverage can turn reasonable growth into very strong returns on your actual cash in the form of ROI or return on investment. With stocks, most investors stay unleveraged, so their returns are only ever on their own capital. The combination of leverage, rental income, and increasing your equity in a property can produce significantly higher returns on your initial capital compared to a similar risk stock portfolio. So leverage is powerful, but there's another factor that can completely derail even the best plan if you're not prepared for it, and that is volatility. Most investors don't distinguish between short-term price swings and actual long-term loss of capital. In 2020 and 2022, we saw major swings in stock indices, drops of 20, 30, and even 40%. Many retail investors who thought they were in it for the long term sold out during these drops because of the stress of watching their money evaporate. Meanwhile, UK property values in hotspot cities didn't swing wildly. They moved gradually, supported by chronic undersupply and strong rental demand. Equities are inextricably linked to the market every second of every day. As an investor in the stock market, you'll track numbers constantly, potentially carrying uncertainty of whether your capital is secure or not. Over 10 or 20 years, that volatility can be worth it, and you may see strong returns. But over 1 to 3 years, especially if you need to exit, these swings can be deeply uncomfortable and lead to rash decisions, which is what you don't want. Property moves into slower cycles. You don't get live pricing updates, which ironically can be good for long-term investors. Ask yourself honestly, if your £50,000 in stock dropped by 25% over the next 12 months, would you definitely hold, or would you be tempted to sell? If you'd struggle to hold on, you may be better suited to an asset where short-term movements are less extreme and returns come from stable income plus moderate growth. Many investors can see the UK property as one flat market. They read a headline that says house prices up or house prices down and assume it applies to everywhere. This assumption is completely wrong. Right now, the UK has a chronic shortage of quality rental accommodation in major cities. Manchester, for example, has seen massive population growth and job growth, with rental demand consistently outstripping supply. Independent forecasts still project growth in key regional markets over the next 3 to 5 years, with both Manchester and Birmingham predicted an additional 18.8% rental growth over the next 5 years. At the same time, over-leveraged landlords are exiting, creating opportunities for better capitalised investors to step in. Property success is localised. While some parts of the UK may stagnate, areas with strong fundamentals such as major regeneration, popular universities, and employment hubs are likely to continue performing really well. Investors who focus on these micro markets use sensible leverage and work with people who understand tenant demand are positioned to benefit from rental growth and capital appreciation. My advice is to focus on 3 things: hotspot areas with proven undersupply and strong rental demand, developments with modern amenities that appeal to today's tenants, and clear projections that still stack up for your personal goals. Work with specialists who provide real data from actual schemes and not just glossy brochures. Now, the worst thing you can do right now is either rush into the wrong property or sit on the sidelines and miss strong opportunities. If you want someone to walk you through the real market and help you run the numbers properly, use the link in the description to book a call with one of our UK property consultants. So, to summarise, where you invest your capital should depend on your personal goals and what wealth means to you. If you've got £50,000 and you're interested in property investment, you'll likely need some financial funding in addition to your capital. In the UK, you can use a mortgage, a long-term loan from the bank, to finance your investment. So keep an eye out for our next video, where we'll be breaking down everything you need to know about mortgages this year.